Hey everyone, and welcome back to Collin Investing. This week has been a roller coaster for the markets, and I am here to break it all down for you. We've seen AI advancements, tariff tensions, and a whole lot of economic data. So buckle up as we dive into what's been happening and what it means for your investments. First, let's talk about the elephant in the room, tariffs. It seems like we're back in an era of trade wars, and the implications are huge. Former President Trump's proposed tariffs are starting to become a reality, and the market is, shall we say, not thrilled. The big concern is that the market hasn't fully priced in the risk of retaliatory tariffs. If these tariffs fully materialize, we're in for a bumpy ride filled with uncertainty. Now, on top of the tariff drama, we had a Federal Reserve meeting this week. As expected, there were no big surprises. Fed Chair Jerome Powell delivered a balanced message, basically keeping everyone guessing about their next move. It seems like the market is more focused on the tariff situation than the Fed right now. But don't forget, we've got a bunch of Fed officials speaking next week. It will be interesting to see if their comments clash with what's happening on the trade front. That conflict could become a major issue in the coming weeks and months. Alright, let's switch gears to some economic data. Next week, all eyes will be on the January Non-Farm Payroll report. Remember how Powell said we don't need further weakening of the labor market to reach the inflation target? Well, he didn't say what would happen if the labor market tightens unexpectedly. Last December, we added 256,000 jobs, and while wage growth slowed a bit, it's still around 4% year-over-year. So what's the prediction for January? Economists are forecasting an addition of 170,000 jobs plus. We're getting annual revisions from the Bureau of Labor Statistics, which could show a more moderate pace of hiring over the past few years. Goldman Sachs even predicts that January's report will see the biggest adjustment ever, with total employment increasing by 2.5 million after revisions. For the Fed, these revisions and the January report might align with their view that labor demand is slowing but still strong enough to support the economy. But here is the kicker. Another strong jobs and wage growth report could reignite fears of inflation coming back in the next few months. Especially with those tariffs looming, the market might start doubting whether the Fed will even cut rates twice this year. Before we get the non-farm payroll data on Friday, we'll also have the ESM manufacturing and non-manufacturing PMIs and the ADP employment report, also known as the small non-farm payroll. Now let's talk about central banks beyond the US. The UK is up next with its first interest rate meeting of 2025. After concerns about the new government's fiscal plans, investors are increasingly betting on a rate cut. But even if a cut happens, it'll likely be a hawkish cut, meaning the Bank of England might raise its inflation forecasts and avoid committing to future cuts. Shifting to commodities, let's look at gold. It's been a wild ride for gold investors this week. Weak US economic data and escalating trade tensions pushed gold to a new all-time high. Technically, it looks like gold is entering a new upward phase. Interestingly, gold is strong even with a stronger dollar. The $3,000 mark is now seen as a key level, acting like a magnet. Any small news event could push gold towards that level. And what about Bitcoin? It took a dive this weekend, falling below $100,000, causing over 240,000 liquidations. But it has since recovered. El Salvador, the first country to adopt Bitcoin as legal tender, is now the first to abandon it. Bitcoin will no longer be an official currency, and its use will be voluntary. This change comes after nearly 2 years of pressure from the International Monetary Fund, IMF, which made reducing Bitcoin risks a condition for loans. So, why did El Salvador reverse course? While some profited from Bitcoin, many more suffered. Most people don't have the ability to buy low and sell high in such a volatile market. El Salvador's Bitcoin experiment, though widely watched, ultimately succumbed to economic pressures, international financial constraints, and public apathy. Let's move on to oil. Oil prices might face further pressure. Canada and Mexico are the two largest suppliers of crude oil to the US. Canada exports about 4 million barrels per Dalton Y to the US, and Mexico exports about 500,000 barrels per Dalton Y. Price pressure is inevitable, even if temporary. However, the US has considered this, and to appease domestic refiners, the proposed tariff on Canadian energy imports is lower, at 10% next week. The trade war officially begins. Mexico's president is activating Plan B, imposing tariffs on US goods. China has mainly condemned the actions without many concrete measures. But Canada's Prime Minister Justin Trudeau is taking center stage again. he announced countermeasures imposing 25% tariffs on $155 billion worth of U.S. goods. The first $30 billion in tariffs will take effect on Tuesday, with the remaining $125 billion implemented within 21 days to allow Canadian businesses to find alternatives. Trudeau is also considering non-tariff measures, including restrictions in key minerals and energy sectors. He's urging Canadians to buy domestic products and travel within the country to protect Canada. There might also be boycotts of products from Trump's base in red states. Other countries might follow suit, targeting the economies of Trump's base. The White House has warned that any retaliation could lead to even higher tariffs. Trudeau dismissed Trump's claims about illegal immigration from Canada, stating that only 1% of illegal entries into the U.S. come from Canada. Many Canadians, including Trudeau, have emphasized the long-standing alliance and friendship between Canada and the U.S. From the beaches of Normandy to the battlefields of Iraq, they've stood together on issues like Chinese Ming, Wanzhou, and 100% tariffs on electric vehicles. Historically, the two countries have shared the same values and fought side by side. Canadian media points out that retaliatory measures could make groceries more expensive. The depreciating Canadian dollar is also pushing up food prices. Some products might not just become more expensive, they might become unavailable. The biggest impact of this trade war will be on ordinary people. It's a self-inflicted wound, not a natural disaster or war permanently. The Canadian Parliament is in recess. With Trudeau's resignation, the ruling Liberal Party is holding an internal election, and Parliament isn't expected to resume normal operations until the 24th of March. So in the short term, 10/25, and it's not just the election, here is not much more that can be done. Undoubtedly, Trump's new tariffs will hit both Canada and Mexico hard, as foreign trade accounts for about 70% of their GDP. Their reliance on the U.S. is much higher than the U.S.'s reliance on them. This gives Trump significant leverage over his North American partners. In the short term, the Canadian and Mexican currencies might depreciate further to mitigate the negative impact of the tariffs returning to the stock market. Morgan Stanley believes that tariffs could push up domestic inflation by raising the prices of imported goods. Goldman Sachs economists estimate that comprehensive tariffs on Canada and Mexico would increase the U.S. core inflation rate by 0.7% and reduce GDP by 0.4%. The possibility of higher inflation is particularly sensitive for investors who fear that a resurgence in inflation could halt Fed rate cuts. Personally, I believe inflation is determined by multiple factors. The Fed will consider employment, wage growth, consumer confidence, and supply chain conditions. Despite the trade disputes, the U.S.-Mexico-Canada Agreement, USMCA, is still in operation and the economies are highly interdependent, making a complete breakdown unlikely. Bloomberg analysis suggests that the new tariffs could reduce overall U.S. imports by 15%, generating about $100 billion in additional annual revenue for the U.S. However, certain sectors of the U.S. economy will be hit particularly hard, including the automotive, energy, and food industries in the short term. Automakers like General Motors, Ford, and Stellantis, which have significant operations in Mexico and Canada, could face major impacts. Industrial manufacturers like Deere, Caterpillar, and Boeing could also face difficulties. Alright, that's it for this week's deep dive into the markets. Next week could be a turning point as global markets brace for tariff uncertainty. But the good news is that earnings season is still in full swing, which might help distract from some of the negative news. So far, I am pleased with the strength of earnings. And the market seems to be as well. Overall, the fundamentals of most stocks remain intact. In the short term, volatility might continue to rise. That's all for this video. Don't forget to like, subscribe, and hit that notification bell to stay updated on all things finance and investing. Your support helps this channel grow, and I truly appreciate it. Remember, the stock market involves risks, so always do your own research and invest wisely. Thanks for spending your time with me today, and I hope to see you in the next video. Bye for now.